Let's say you already know how many shares you wish to purchase of the stock or ETF you've decided to invest in. You merely need to place the order at this point. However, because of the need to select an order type before making an order, rookie investors may find it more challenging than it appears. Order types are essentially instructions to your broker on how to carry out your trade. You don't need to know the complicated jargon or hand signals traders use on the floor of the New York Stock Exchange, but you should understand the basic order types and how they affect your trade. Hey, welcome to Stock Market Mate. Today we'll talk about the basic stock order types. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Market order versus limit order. The two major types of orders that every investor should know are the market order and the limit order. Market orders. The most fundamental sort of trade is a market order. It is an order to buy or sell something immediately at the usual price. The amount you pay to buy a stock will typically be at or close to the advertised ask. If you decide to sell a stock, you'll get a price that is equal to or close to the posted bid. Individual investors who wish to purchase or sell a stock rapidly often use market orders. By using market orders, you have the benefit of knowing that your trade will be filled and completed as soon as possible. Market orders for stocks that trade over tens of thousands of shares per day will be probably executed close to the bid or ask prices, even though the investor does not know the exact price at which the stock will be bought or sold. Limit orders. A limit order, sometimes called a pending order, allows investors to buy and sell securities at a certain price in the future. This type of order is used to execute a trade if the price reaches the predefined level. The order will not be filled if the price does not reach this level. In fact, a limit order sets the maximum or minimum price at which you're willing to buy or sell. For example, if you wanted to buy a stock at $10, you could enter a limit order for this amount. This means that you would not pay 1 cent over $10 for that particular stock. However, it is still possible that you could buy it for less than the $10 per share specified in the order. There are 4 types of limit orders. Buy limit. An order to purchase a security at or below a specified price. Limit orders must be placed on the correct side of the market to ensure they will accomplish the task of improving the price. For a buy limit order, this means placing the order at or below the current market bid. Sell limit. An order to sell a security at or above a specific price. To ensure an improved price, the order must be placed at or above the current market ask. Buy stop. An order to buy a security at a price above the current market bid. A stop order to buy becomes active only after a specified price level has been reached, known as the stop level. Buy stop are orders placed above the market, and sell stop orders are placed below the market, the opposite of buy and sell limit orders, respectively. Once a stop level has been reached, the order will be immediately converted into a market or limit order. Sell stop. An order to sell a security at a price below the current market ask. Like the buy stop, a stop order to sell becomes active only after a specified price level has been reached. Market and limit order costs. When deciding between a market or limit order, investors should be aware of the added costs. Typically, the commissions are cheaper for market orders than for limit orders. The difference in commission can be anywhere from a couple of dollars to more than $10. For example, a $10 commission on a market order can be boosted up to $15 when you place a limit restriction on it. When you place a limit order, make sure it's worthwhile. Let's say your broker charges $7 for a market order and $12 for a limit order. Stock XYZ is presently trading at $50 per share and you want to buy it at $49.90. By placing a market order to buy 10 shares, you pay $500, 10 shares times $50 per share, plus $7 commission, which is a total of $507. By placing a limit order for 10 shares at $49.90, you would pay $499 plus $12 commissions, which is a total of $511. Even though you save a little from buying the stock at a lower price, you will lose it in the added costs for the order, a difference of $4. Furthermore, in the case of the limit order, it is possible that the stock doesn't fall to $49.90 or less. Thus, if it continues to rise, you may lose the opportunity to buy. Additional stock order types. Now that we've explained the two main orders, here's a list of some of the added restrictions and special instructions that many different brokerages allow on their orders. Stop loss order. A stop loss order is also referred to as a stop market, on stop buy, or on stop sell. This is one of the most useful orders. This order is different because, unlike the limit and market orders, which are active as soon as they are entered, this order remains dormant until a certain price is passed, at which time it is activated as a market order. For instance, if a stop-loss sell order were placed on the XYZ shares at $45 per share, the order would be inactive until the price reached or dropped below $45. The order would then be transformed into a market order. The shares would be sold at the best available price. You should consider using this type of order if you don't have time to watch the market continually but need protection from a large downside move. A good time to use a stop order is before you leave on vacation. Stop limit order. They are similar to stop loss orders, but as their name states, there is a limit on the price at which they will execute. There are two prices specified in a stop limit order: the stop price, which will convert the order to a sell order, and the limit price. Instead of the order becoming a market order to sell, the sell order becomes a limit order that will only execute at the limit price or better. This can mitigate a potential problem with stop loss orders, which can be triggered during a flash crash when prices plummet but subsequently recover. All or none, or AON. This type of order is especially important for those who buy penny stocks. An all or none order ensures that you get either the entire quantity of stock you requested or none at all. This is typically problematic when a stock is very illiquid or a limit is placed on the order. For example, if you put in an order to buy 2,000 shares of XYZ but only 1,000 shares are being sold, an all or none restriction means your order will not be filled until there are at least 20,000 shares available at your preferred price. If you don't place an all or none restriction, your 2,000 share order would be partially filled for 1,000 shares. Immediate or cancel, or IOC. An IOC order mandates that whatever amount of an order that can be executed in the market or at a limit in a very short time span, often just a few seconds or less, be filled and then the rest of the order cancelled. If no shares are traded in that immediate interval, then the order is cancelled completely. Fill or kill, or FOK. This type of order combines an AON order with an IOC specification. In other words, it mandates that the entire order size be traded in a very short time period, often a few seconds or less. If neither condition is met, the order is cancelled. Good till cancelled, or GTC. This is a time restriction that you can place on different orders. A good till cancelled order will remain active until you decide to cancel it. Brokerages will typically limit the maximum time you can keep an order open or active to 90 days. Day. If you don't specify a time frame or expiry through the GTC instruction, then the order will typically be set as a day order. This means that after the end of the trading day, the order will expire. If it isn't transacted, then you will have to re-enter it the following trading day. Take profit. A take profit order, sometimes called a profit target, is intended to close out the trade at a profit once it has reached a certain level. Execution of a take profit order closes the position. This type of order is always connected to an open position of a pending order. Bottom line. Knowing the difference between a limit and a market order is fundamental to individual investing. There are times when one or the other will be more appropriate. The order type is also influenced by your investment approach. And that's about it for today's video. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!